Hello friends, I welcome all of you to my YouTube channel. Friends, I will tell you about what is insurability in insurance. Insurability risk which can be insured by private companies typically share 7 common characteristics. Number 1, a large number of similar exposure units. Since insurance operates through pooling resources, the majority of insurance policies cover individual members of large classes, allowing insurers to benefit from the law of larger numbers in which predicted losses are similar to the famous individuals. However, all exposures will have distinct differences which may lead to different premium rates. Definite loss, and this is very important. This type of loss takes place at a known time and place from a known cause. The classic example involves the death of an insured person on a life insurance policy, while automobile accidents and worker injuries may all easily meet the criterion. All other types of losses may only be definite in theory. Occupational diseases, for instance, may involve prolonged exposure to injurious conditions where no specific time, place, or cause is indefinable. Ideally, the time, place, and the cause of a loss should be clear through enough that a reasonable person with sufficient information could objectively verify all the three elements. Accidental loss. The event that constitutes the trigger of a claim should be fortuitous or at least outside the control of the beneficiary of the insurance. The loss should be pure because it results from an event from which there is only the opportunity for cost. Events that contain speculative elements such as operating risk or even purchasing a lottery ticket are generally not considered insurable. Large loss. This size of the loss must be meaningful from the perspective of the insured. Insurance premiums need to cover both the expected cost of losses plus the cost of insuring and administrating the policy, adjusting losses and applying the capital need to responsibly assure that the insurer will be able to pay claims. For small losses, these latter costs may be several times the size of the expected cost of losses. That result hardly any point in paying such costs unless the protection offered as real time the size of the loss. Affordable premium, calculatable loss, and limited risk of catastrophically large loss. These are the other, you can say that the losses which would be covered under this insurability. Insurance, you can see limited risk of catastrophically large losses. Insurable losses are ideally independent and non-catastrophic, meaning that the loss do not happen all at once and that individual losses are not severe enough to bankrupt the insurer. Insurers may prefer to limit their exposure to a loss from a single event to some portion of their capital base. Capital contains insurers' ability to sell earthquake insurance as well as bond insurance in hurricane or horizon or zones. In the United States, the federal government ensures flood risk in specifically identified areas in commercial fire insurance. It is possible to find single properties whose total exposed value is well in excess of any individual insurer's capital constraint. Such properties are generally shared among several insurers or are insured by a single insurer, which syndicates the risk into the reinsurance market. I hope, friends, you have understood all the details about the insurability. Hope to see in the next video again.